With Disney reporting earnings after today's close, Mark, I wanted to tap your expertise in TMT banking from your days at Houlihan Lokey and start there. I know a couple years ago you spoke with us in 2018, and you were kind of bearish on Netflix, saying you would never want to be long that company because you don't believe consumers would pay $150 a year for a few good shows. Looking at the streaming landscape now, which has just gotten more crowded, what kind of company has pricing power in this environment?
Well, I think the benefit to a Disney, which is obviously interesting today because of earnings coming out, is that they were able to monetize very effectively Marvel, Star Wars. They took things back. They've packaged it. They've launched new content around it. I mean, I think the tentpole model that worked in the film business is being replicated online. I think that seems pretty obvious. So I feel optimistic in that regard. There's also segmentation. So Disney obviously has Hulu for adults and ESPN, for I guess men in there.
For you?
Yeah, for me, exactly. And now Disney Plus. There'll be a question of how you cross-pollinate effectively, and leadership-wise, what they'll be able to do to actually bring in some, streaming DNA into the company. Obviously, with Randy leaving, that opens up an opportunity for some new talent to come into Disney. But they've done such a good job. I just read Bob Iger's book over the holiday, and I think he's just been phenomenal about taking the right risks, but also doubling down where he knows he can kind of predict what the outcome's going to be in something. And it's a really good balance that's held up well for them.
Streaming, though, isn't a sure shot for everybody. It's the new reality, but how do you make money for it? Who do you think in media is the most revolutionary CEO that we're seeing today? Who has it right?
Well, look, you have to give Reed a lot of credit for what he did in turning a CD distribution business into a streaming business. I think Bob Iger, when they bought Marvel, knew what they were doing. I don't think they bought it to make movies solely for theatrical release. So I think it depends on what you're looking for, but from an innovation standpoint, I think a lot of these things that have been done, we're all keeping in mind the fact that having a relationship with the consumer was core to success, and the way you did that was by providing them with something that others don't have.
So, Mark, I want to talk about what you're doing now, which is your own firm, Patricof Company, with backing from JPMorgan, and you deal with professional athletes, including my boyfriend, Henrik Lundqvist.
He has a lot of girlfriends, it
I know,
seems, but I know his wife doesn't agree with that.
I think I can. But this is more than just endorsements. I mean, this is kind of a step
We don't do endorsements.
Right.
We don't go anywhere near that.
So explain what you do with these athletes.
The philosophy for us was basically these athletes have a unique opportunity in their local markets, especially, but also nationally, to access investment opportunities that are otherwise off-market, oversubscribed, just not available to the average direct investor. So the idea for us was, could we pool a specific number of those athletes into one team, in a sense, pair their capital with ours and JPMorgan's, and gain access to high-quality transactions would otherwise never be on the open market for outside investors.
So when you go to these athletes, though, I mean, what is the selling point? I mean, how do you sort of pitch that to them in a way that they understand the potential benefits?
So if you speak of, think about an athlete and their average sort of set of advisors. They've got an agent who's clearly working on their contract. They may have a marketing person working on endorsement deals, and hopefully they've got a good financial advisor. The lane that exists that's in between those three is for alternative investments, real estate, venture capital, private equity, et cetera. To date, they've been over-allocated to venture early stage deals, primarily reactive to whatever may be handed to them in the locker room or through a friend of a friend. So we sort of pitched the idea of being proactive, creating a strategy around your alternative investments and coming up with an allocation that actually represents your interests and what's available to you, how you can be more proactive in doing that. So we advise athletes on real estate investments and primarily in growth and private equity. We've stayed away from venture mainly because we think that a better model for them is to invest in more predictable companies, recycle their capital, reinvest, and kind of grow their net worth that way versus taking kind of big shots down the field.
So what kind of opportunities are the private equity universe getting to them? The KKRs and the L Cattertons of the world, are they letting these athletes in with open arms?
Yeah, what we're finding is, and we went out and met with all the top private equity funds before we launched the business. I represented most of them on the buy side one time or another when I was doing my investment banking work, and realized that if they were cutting a $500 million check, there might be room for us to leapfrog an LP if there was excess allocation, to invite us into a transaction where they thought maybe having 20 or 30 pro athletes on the cap table might add some value. We don't guarantee any endorsement relationship, but the whole thesis was around the fact that if you invest $50,000 into a company, you are far more likely to lean into that investment than if someone had paid you, that same company had paid you $50,000 for a specific number of social media posts or an appearance or two. And that was really the basis of the business. And we've also done a fair amount to empower our athletes with a combination of customize content for them. We evaluate all their inbound deals. We do board placement. We host events. So Henrik is a good example of someone. We host dinners for them where they are able to be introduced to multiple private equity partners and enhance their business relationships so they can go off in the world and do the kind of things they want to do, and with our help when necessary.
In terms of the risk profile of these investments, do they run the gamut from kind of really taking on a flyer to some more conservative investments?
We're really staying around the kind of hoop of growth equity and private equity. So late stage deals, Series D, E, pre-IPO rounds. We invested in the Real about 2 months before it went public. We invested in Topgolf, which I think has announced its IPO. We invested in Cholula Hot Sauce with El Catterton. So later stage deals, profitable companies where we know there's a predictable return. So the downside for us is more of a 1x than it is losing your money.
Got it.
So how big are these checks that you're writing at any given time?
We're looking at investment opportunities sort of $10 to $30 million per investment.
And you had also said that JPMorgan just doubled down as well in your firm. What do they bring to the table?
So they were a really good partner for us. It's the private equity group inside of JPMorgan. They helped launch the company about 18 months ago. They now just doubled their investment and came in again for the second time last week. So, they've been a good brand partner for us. They have good intelligence. They're smart, interesting people. I think it's been really good for us to launch inside of the business. We're actually sort of moving out on our own physically now, but basically was incubated as a method of launching the company.